Okay, I have a couple of you on Zoom. Somebody give me a little thumbs up or something if you can hear me in the Zoom room. Okay, I got a thumbs up. Okay, I'm having a little trouble with the technology, so I'm gonna try to share my screen here on Zoom, and I'm sharing a different screen in class, so that's not ideal. So as I jack this up tonight, just make fun of me in the comments, and that'll be a good archival for the next class. Maybe they can get a good kick out of that. Okay. So while I'm trying to get this Zoom room to work for everybody online, how's homework going? How's the exam going? If anybody's taken it, any questions about the exam, the format, that type of thing? Nothing, no questions. You guys are good. You get good on the homework, good on the exam, got the exam window open through next week. This is the lecture that I refer to as brain pollution, because everything that we cover tonight is not on the exam. I don't even know why any of you showed up tonight. It goes into your short-term memory banks, and then you purge it after the exam's over. So you're going to have all this convoluted material confusing you on the exam, but I appreciate your efforts. And I'm joking. No, I appreciate it. But tonight's material will be on the second exam. You have another week to take the first exam. I think I sent out an announcement. If memory served, I left the window open until 11:59 p.m. next Monday night. So if you're a procrastinator, you got a full week before you need to take that first exam. You'll get 120-minute window. As soon as you click on take the test, timer's going to start. 120 minutes later, 2 hours later, the test closes. Doesn't matter if you're done or not, that test closes. So be smart about how you take it. You can go forwards and backwards as you take that test. Go through it once, answer all the questions you know, come back, bookmark anything that you need a little bit more time with. It's open book, open note. Should be able to work the text to help you out a little bit. I was going to say one other thing and I lost it. Okay, if it was important, it'll come back to me. Okay, we do have quite a little bit of material to cover tonight. We're talking about revenue recognition policies. Somebody throw out a company that they're working on. I got now that I have some cards, I can pick on you. Caleb, where's Caleb? And you're all wearing your masks. Hey, Caleb, so you're working. What's your company?
Right now,
Pfizer. So, well, that's terrific, because that's the exact example that our authors are using in in the text. So you should be able to take a lot of that material and just update it. I think it's 1819. So Pfizer, when would a company like Pfizer recognize their revenue? It's not a trick question. How does revenue show up on their books? When people buy their products. So there's cash that exchanges hands, and what's Pfizer make? I don't know, some drug that goes back the other way. They make I should know this. What's their big drug? Lipitor. Lipitor is their big one. It's off patent now, but it was billions and billions of dollars for Pfizer for decades. So I go to the pharmacy, I give cash for Lipitor. What if I pay with my credit card? Anybody? This is open to the whole class. Does that show up as revenue? Yes, it does. It absolutely shows up as revenue. That's one of the key concepts of revenue recognition. When does the revenue line item actually get booked? And we're going to go through several examples and some guiding principles that we use when we're trying to figure out when to actually record revenue. And then there's a whole bunch of offsetting kind of one-off type items like sales returns and allowances and allowance for uncollectible accounts and so on and so forth that you've been exposed to before. I want to take those concepts and go just a little bit deeper tonight and talk about how, if you were so inclined, you might manipulate those numbers to get another penny reported on your quarterly earnings statement. And what happens when you can find the penny? Anybody? In this example, you're the greedy CEO. You can make more money. You're the greedy CEO whose compensation may be linked to earnings per share. And if your compensation is linked to earnings per share, or just as common, earnings per share growth, period over period, quarter over quarter, year over year, say you're a short timer. Say you're 65, you've already announced your retirement. 1 penny could make the difference between a year's worth of vesting and a bunch of options going unexercised. So if you can find the penny by overestimating or underestimating sales returns and allowances, or allowance for doubtful accounts, we need to know how that works. Maybe we're the ones that need to get paid someday. In this setting, we're the analyst team that has been charged with uncovering these types of events so that we can know whether or not we're dealing with a scrupulous management team and whether or not we're dealing with a company that we want to actually pair our capital with. So very high level, that's what we're talking about tonight. And we'll go through a few examples here in detail about what revenue recognition means. And we'll really end up going all the way through the income statement tonight. So Caleb, there you go, Pfizer's income statement. Hopefully this looks familiar to most of you in class. You've been through several accounting courses at this point, recognize an income statement and a balance sheet. Pfizer books revenues and then immediately offsets that with cost of sales, or cost of goods sold is probably what's more familiar to most of you in this class. And then they offset selling, research and development, amortization of intangibles, restructuring charges, et cetera, all the way down to net income. And we're going to touch briefly on each of these line items tonight. So the revenue recognition rule is right here. FASB gives this to us. If you wanted to shortcut this and remember one thing, or one big takeaway from this slide, it would be the second bullet point from the bottom where it says, when the customer obtains control. So we've actually transferred a good or a service at this point. Transfer and control are 2 key words when it comes to determining whether or not we've actually made a sale. And there's a lot of peculiar types of sales that are borderline gray area, like sales on consignment or sales leasebacks. And we'll go into the accounting for sales leasebacks a little bit later in the semester. Okay. What I want to do now is take all the animations out of this slideshow because they distract me, and there's a way to do it. I think it's File, Options, maybe Advanced. Somebody help me out here if you know. All right, I can't find it. I'm just gonna have to deal with it. Okay. Okay, sales on credit. And again, that's that keyword transferred there in the second bullet. Once we've transferred the goods, regardless of whether or not it's a cash sale or a credit sale, we're going to book the revenue. Now, actually collecting that cash is a whole different problem. And we'll touch on that here in a minute. But as soon as we transfer the good or service, we're going to book the revenue. The 5 steps that you'll want to remember for the revenue recognition begin here on slide 6. And for a company like Pfizer, when you're selling multi-million-dollar, maybe multi-billion-dollar deals with Cardinal Health and McKesson and the other major drug distributors, you'll have each of these key components of a contract. You'll be able to identify the contract, the performance obligations, the when, what, and where to every drug prescription that falls underneath that agreement, and then transaction price. Number 4 and 5 would be the allocation of the transaction price and when the drug or service is actually delivered. And those performance contracts can get a little bit, they can get a little bit confusing. Say, for example, well, the authors use the example of Lowe's. So Lowe's selling big pieces of machinery oftentimes comes with service contracts. So selling the piece of machinery, that obligation can be met on day 1. Delivering on that ongoing service contract maybe 3, 4, 5 weeks. So when do you book the revenue if it all comes in one payment? I'm gonna throw that question out there. Anybody want to answer it? Guesstimates are fine. When would you do it if it was your company? What seems, let's give FASB the benefit of the doubt. They probably did something that makes common sense.
I feel like everyone would be for revenue when the good or service is provided.
Yes, exactly. So that creates an estimate. And what are you supposed to think every time you hear the word estimate in this class? Every time you hear the word estimate in this class, I want you to think an opportunity for manipulation and or shenanigans and or just out and out fraud. So in the example you just gave, that would require an estimate. How much of the contract that we just sold, which is part goods and part service, how much of it is goods and how much of it is service? If we wanted to book revenue in the current period, we would estimate that more of it was goods. If we wanted to book revenue in subsequent periods, you would estimate that more of it was service. And you have the opportunity to draw that line. Now, the auditors are going to come in and they're going to take a look at what you did. And as long as it's not too far out of whack, they're not going to take issue with it. That gives you plenty of opportunity to find the penny and to add an extra cent to your EPS. And here's Pfizer's revenue recognition policy. You can see clearly here that they book revenue when the good or service is transferred. And then they have 5 or 6 different chargebacks. They say right there where the arrow is pointing, says such variable consideration represents chargebacks, rebates, sales allowances, and sales returns. Every single one of those items, chargebacks, rebates, sales returns, and allowances, all require estimates. So there's 1, 2, 3, 4, probably another 5 or 6 opportunities for Pfizer to estimate what their revenues are really going to be, because FASB requires offsetting accounting entries anytime we know we're going to get a sales return in the future. If we know that 3% of our sales come back at us, FASB says, well, you need to book an offsetting entry of approximately 3% for every dollar's worth of sales that you book on your income statement. In theory, that makes perfect sense. And in practice, most of the time, it works out that way. But because it does require an estimate, and it requires some work on our part because we don't have crystal balls and we don't know the future, it can introduce the opportunity for accountants and executives to game the system a little bit. And here are some of those complications. Not necessarily for shenanigans, but these are some of the gray areas where that transfer of control is so crucial. And FASB updated the guidance on revenue recognition a few years back. These gray areas used to be even more gray. Now they're a little bit more understandable, but non-refundable upfront fees, when do you book it? Same story when transferred, right? Whenever there's any question about when you book revenue recognition, when transferred, go back to when transferred, when transferred, when transferred. Bill and hold relationships, consignment sales. Licenses can be a little bit tricky. If you have the right to use software or the right to use intellectual property, the promise of access or the promise of that license is typically recognized over time. That license is usually for a period of, I don't know, 6 months, 12 months, 24 months. So you would recognize that revenue evenly throughout that period of time. Franchises, variable consideration, both those are when goods or services are actually transferred. Multiple element contracts is what I was just referring to with the example of like a Lowe's. Rights of return, gift cards. Gift cards is a good example. You go into Target, Apple, Best Buy, wherever, you buy a gift card. What do they do with that money? They haven't delivered a good or a service, but you just paid them. What's that accounting entry look like? Always start with cash. Whenever you're analyzing any accounting entry, always start with cash. Cash is, well, start with cash because it's easy. It's cash is either coming in or going out. So that's your debit or your credit. So if somebody walks into, let's just use into your Apple store, and they buy an Apple gift card and they pay you cash, well, you're going to debit cash. What are you going to credit? What's the offsetting credit? You haven't delivered a good or a service, so it's not going to be revenue. It's a liability. It's the obligation to deliver a good or a service in the future. And then in the future, when we actually deliver that good or service, we'll have an offsetting revenue and a debit against that liability that we booked. So yeah, 100% right. Anybody know what the name of that liability is? That is, it wouldn't be an accounts payable. It would be a contra liability referred to as unearned revenue. So we haven't earned it yet. We're going to book it as unearned revenue. And then in the future, we'll create a reversing entry. Yes, sir. Yes, it is. It's the same thing as deferred revenue. And if you can remember that, you will save yourself a lot of pain and headache, because our authors use them interchangeably, and other accounting classes will also use them interchangeably. And it took me an embarrassingly long amount of time to come to that realization for myself. When I did, like, oh, those two things are the same thing. So keep that in mind. You'll save yourself some headache. What if we're a construction firm? Say we're Jacobs Engineering and we're working on a nuclear power plant. It's going to take 5 years to build. And we get to the end of the first year and we've spent $100 million. So we have $100 million in costs that we've put into this nuclear power plant facility. How do we book that revenue? How about somebody from our Zoom room? Nah, you guys all thought you were safe. You're all watching Monday Night Football. You're not fooling me. We're going to book that revenue over time. If it's a 5-year facility, typically we would book that revenue in increments of 20% each over 5 years, or we may book it based on the amount of materials that we've put into the project. So if 80% of the costs are going to come in terms of the first year, meaning we have to buy all of the raw materials, the wood and steel and chemicals and everything else that goes into the plant, we might book that revenue a little bit disproportionately, or actually proportionately relative to costs, disproportionately relative to time. You're probably going to have to read the footnotes on something like that. That's the cost to cost method. Always read the footnotes for more detail on everything that we're talking about in class. This cost to cost method is exhibited here on slide number 12. Raytheon signs a $10 million contract and they book 60% of the cost and hence 60% of the corresponding revenue in year one, with the remaining 40% in year two. So the math breaks down pretty simple. I think this was a $7.5 million contract, which was, looks like it was a $10 million contract with $7.5 million worth of what will basically amount to cost of goods sold. They incurred 60% of that cost in year one, so they booked 60% of the revenues. And on the next slide here, we can see how that breaks down in terms of debits and credits. In year one, follow the cash. We take in $4.5 million worth of cash. Excuse me, we spend $4.5 million worth of cash, so that's going to be our credit. Our offsetting debit is cost of sales for the same 4.5 million. In year one, we'll book $6 million worth of revenue. We haven't received that cash yet, so we're going to book it as an accounts receivable, with the offsetting being a $6 million revenue. And then in year two, basically the same entries, only we're booking 40% of the remaining contract. Okay, I don't need to spend any time on that slide. There I am. Okay, notice on Raytheon's balance sheet here, the $4.5 million that we spent in year one on that construction project shows up on the balance sheet as a line item called contract assets. So in effect, this is like work in progress. And that's a new term that you might not have seen before. It could have showed up as work in progress or contracts in progress. Or my point here is that companies have the ability and the latitude to name that whatever they want to name it, which makes your job as analysts a little bit more challenging, because you're going to be breaking down some of these financial statements, and every year when we get to a little bit later in the semester and you're doing some of the heavier number crunching, I always get questions about, well, what about this account? What about this account? And I don't know, because management teams have the latitude to name these whatever they want. You're going to have to go to the footnotes to find out exactly what that is. And then you as the analyst will be able to come to some determination about whether or not that's a liability, an asset, revenue, expense, and then whether or not that specific line item is germane to the ongoing operations of the company, which is generally what we're after. As an analyst, what we generally want to know is how much cash is this company going to generate in the future? And determine how much cash this company is going to be able to generate in the future, we want to identify and isolate only the ongoing portion of the business. If the management team is scuttling part of the business, if it's a discontinued portion of the business, as an analyst, you're going to be inclined to just set that aside. Now, word of caution, because here in a minute, we will talk specifically about discontinued operations and how you book those. You generally book them net of tax, and you separate gains and losses from the ongoing portion of that discontinued segment versus the selling price. Word of caution, management teams know that if they label something discontinued, it won't draw the scrutiny of the Wall Street community. So this is just my theory. I've never had a management team admit to doing this, but if you look back over the last 10 years, and you see a consistent history of booking discontinued operations, that what that signals to me is that every quarter, every year, every other year, the management team is getting together and saying, okay, what can we set aside so that the Wall Street community is not faulting us and our management team? How do we paint a rosier picture of the future? Well, if we got rid of this dog, this plant that is underperforming out in Kansas City or Omaha or Oklahoma City, our financials sure would look a lot better. So let's set that aside. We'll call it discontinued operations. And then we'll publish pro forma financials that show what our business would have looked like if that entity hadn't dragged us down, so to speak. So I always took it as a little bit of a red flag whenever I would see a steady history of discontinued operations or anything else for that matter, that the management team was telling me wasn't pertinent to the future operations of the firm. Okay, and you'll notice I'm skipping some of these slides, as I have a tendency to do, because there's a lot of slides and I don't have time to get through them all, and they're pretty self-explanatory. Okay, let's move into sales allowances, because this is one of those areas that we'll have an opportunity to make some adjustments as analysts. We need to adjust for rights of return. Most customers have the opportunity to return merchandise. We need to account for that. We need to account for sales discounts. We need to account for retailer promotions. And we can estimate those most of the time. We can estimate those fairly accurately, given our own history. So this example cites Levi Strauss. Levi's been selling jeans for how long? Over 1919, is that when Levi started, something like that? We'll call it 100 years. They probably have a pretty good idea what their sales returns and allowances are going to be as a percentage of their total sales. Very long history, which is one of the reasons why when I set that screen up at the first of the year, one of the requirements is that a company has 10 years worth of history for you all to select from, because I want to be able to run analyses just like the one that we're running here. Levi expects 3% of sales to be returned. So we're going to isolate one sale. They sell a pair of jeans for $130 and the jeans cost $80. So there's $50 worth of profit that's going to drop to the bottom line when they sell these jeans. To establish the allowance for sales returns, we're immediately going to take 3% of that sales price. 130 times 3% is $3.90. We are going to debit the allowance for sales returns account, and we're going to credit the sales returns and allowances account. Now, both of those are on our balance sheet, and in the future, when we actually have a sales return, we will offset that against the sales returns and allowances account. Now, you see the simultaneous entry. This is a dual entry. As soon as we book an allowance for sales returns, we also have to book the corresponding cost of goods sold estimate. So I don't know, 80 into 130, what's that as a percentage? 70%, 75%, 75% of the revenues are cost of goods sold. So you can see here that the inventory adjustment is $2.50. That's a debit to inventory. And then the corresponding credit would be $2.40 to cost of goods sold. And it flows through to the income statement, as you can see there on the bottom. This is the 10K disclosure doc. These are the footnotes. And this is exactly how you would uncover anything, any gamesmanship that might be going on in the financials. You want to look at the beginning of period sales returns, any additions that took place during the year, any deductions, and then the balance at the end of that period. By analyzing these numbers, we're going to be able to identify any distortions that might have occurred during the year. how would you boost earnings playing around with this number? So what do we know about the accounting for sales returns and allowances? We know that it's a direct deduction to sales. So Levi Strauss booked 3%. If they wanted to boost their earnings, remember, that's an estimate. They get to set that at whatever they want. They pick 3%, could have been 4%, 5%. If you wanted to boost earnings, where do you set that number? Lower than 3%. Exactly. So now somebody buys a $130 pair of jeans, sales returns and allowances is not 3% anymore. Now it's 2%. Now it's a 2% direct offset. So you just found 1% profit margin. You just increased your bottom line by 1%, which is huge. If you can increase your profit margin by 1%, anybody in this room have a management team whose salary and incentive comp is linked to margin? Okay, one, here's where you can find that. Good to know. Okay, slide number 21 tells us how to do that. What you want to look at when you're trying to find any abnormalities in the sales returns and allowances accounts, you want to look at additions to gross sales. Then you want to look at allowances as a percentage of gross sales. Number 2 is the biggie. That's what you want to analyze across time for variations. That's the 3% number that Levi used. If you see 3%, 3%, 3%, 3% for the last 10 years, and then all of a sudden it drops to 2, ding, 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 that's your red flag. Something's just gone a little bit off the rails there. And then lastly, you can look at the adequacy of the allowance amount. These all show up in the metric analysis on page 22. This is what I want you to do for your target companies. The research projects that you're working on this year, I want to make sure that you have identified allowances as a percentage of gross sales. So I think this is Levi's we're still looking at here. That's the bottom number, allowances as a percentage of gross sales. So 2016, 2.8, 2017, 3.3, 2018, 2.8. Now they tell you they're using 3%. How does that square with your expectations? Yeah, okay. 3%. That sounds good. It's consistent with 16, 17, and 18 anyway. There's another number about halfway up there, additions charged to gross sales. So additions would be the allowance account as a percentage of gross sales. No. I said that wrong. Additions charged to net sales. So that would include sales returns and sales discounts and incentives. Both of those total to an additions line item for Levi Strauss here. So that would be another one that you would want to monitor if Levi was your company you're doing work on this semester. Okay, here's where the real work of being an analyst comes in. If you're looking at your company and you decide that something's a little bit funky, doesn't look quite right, one of those numbers was out of whack with where it had been in the few years prior. Now it becomes your job to say, okay, well, I have to reconcile for that. If I don't believe the numbers that the management team is giving me, which is your prerogative as an analyst, that's what this class is all about, financial statement what's the name of this class? Analysis. If you decide that it's BS, which you can do, then it becomes your job to restate it. And what are you going to do next? That doesn't sound believable. Okay, make it believable. That's called recasting the financial statements. So we want to recast the financial statements. In this example here, I think this is for Pfizer. So in this example, we're going to look at the additions charged divided by gross sales. And we're going to look at that for the last 3 years and compute an average, which is what our authors did here in this example. You can see additions charged to the numerator divided by gross sales in the denominator. The average becomes 10.04. Now, using that number, we can recast the 2018 financial statements as if total additions equaled 10.04% of gross sales. Now, one thing I take issue with in the way that the authors did this, they included 2018 in the numerator, which I wouldn't do. Because if you, as an analyst, think that there might be something a little bit weird going on with these financials, kick that one out. It shouldn't be a part of your sample set. Use 15, 16, and 17 to compute your average. Don't use the year in question to compute the average that you're going to also use to recast your financial statements. That's just my opinion. The authors are teaching it this way. We can learn it this way. It's not going to make a big difference. So now that we've computed an average additions to gross sales number, we can take that average and use it to recast or restate the income statement here. And you see that we have net sales less additions charged, and we have two numbers there. We have an adjusted number and we have a reported number. So you can see if you go left to right, 16 adjusted was 509, reported was 521. 17 adjusted was 548, reported was 553. Both of those numbers were adjusted down. 2018 adjusted was 620, reported was 603. That number was adjusted up. So that's going to lower our earnings number, be a larger net offset to sales. So be familiar with that process. You need to star that or come back to it or review it. There's likely a homework question and a test question on recasting financial statements. Not terribly complicated, but you just need to be familiar with the steps. And if you do it once or twice, you'll have that no problem. Here we go. Unearned, i.e. deferred revenue. So recall, we talked about this just a minute ago. What happens when you buy a gift card? Somebody comes in, gives you the cash, you got to book the cash. That's a debit. The offsetting credit is going to be unearned revenue. Unearned revenue or deferred revenue is going to sit on your books until, go all the way back to the first slide of the class. The good or service is transferred or delivered. So the what you want to know about unearned or deferred revenue is that it is a liability. That can be a little bit tricky. And you'll also hear that account referred to as a contra revenue account because it's is that right? Contra asset account. Yeah, contra asset, because it's a liability. It shows up on the balance sheet, but it's in the asset section. So it's a deduction to assets. So it's a contra account. I'll show you when we get to the balance sheet here in just a minute. Okay, let's talk foreign currency translation adjustments and losses. And I'm just going to tease you with foreign currency translation adjustments and losses because later this semester, I think it's module 10, we get to do half a class on foreign currency translation adjustments and losses. And that's about as exciting as I can make it. So we get to the end of the quarter, and what happens when we get to the end of the quarter? You all have financial statements that you're looking at, what currency are those financial statements denominated in? Yeah, they're all dollars. That's not a trick question. But for a company like Pfizer, you probably have business that's been done in euros. You probably have business that's been done in yen. You probably have business that's been done in yuan or renminbi. You probably have business that's been done in, you name it. Pfizer's a global institution. They sell product to everyone. So every one of those locales has its own accounting. And at the end of the quarter, you have all this business that's been done in these foreign currencies. Well, what do you do with that? You have to report financials to your investors, and you can't issue them 20 different reports, all denominated in a different currency. How's that work? Well, you have to translate it. So at the end of the quarter, you take all of this global business and you translate it back into dollars. Well, what happens if the dollar has significantly appreciated or depreciated over that time?
Revenue will be higher or lower.
Revenue will be higher or lower on the income statement, 100% right. And then on the balance sheet, you will have something called an unrealized foreign currency translation adjustment. And depending on how foreign currencies have fluctuated, that can be a really big number, which is why FASB tells us to report it below net income in something called what's it called when you report it below net income? Somebody help me out. I just lost my train of thought. Other comprehensive income. And I call it the basement. Foreign currency translation adjustments, pension gains and losses, gains and losses on hedges and swaps, and there's a couple others that we'll get to in Module 10. All of these accounting fluctuations can be so large and so infrequent, FASB tells us as accountants that rather than post them to the net income line, which can distort the use of the financials for all analysts, take that data and put it below net income in a section called other comprehensive income. And that is a signal to us as an analyst that that's somehow unusual or infrequent in nature, and we should treat it accordingly. Not necessarily ignore it, but yeah, kind of ignore it. Because it's not net income, it's something different. So for Pfizer, look at this. For Pfizer, where was that? 31. I think the impact of foreign currency translation gains and losses was 310 million. So yeah, that's a pretty good sized effect. That's a $310 million gain that they had in 2018. Okay, now put your analyst hat on. You read this footnote. Pfizer just booked a $310 million gain from foreign currency translation. What do you do with that as an analyst?
What's the percentage of the entire revenue from that versus US dollars?
I'd want to know that. What I want to know if I'm thinking about buying Pfizer is, again, we want to be able to assess the health and ideally forecast the cash generating abilities of the business into the future. What's the likelihood that that 310 million is going to power those efforts going forward? Zero. That's a translation gain or loss that Pfizer's management team had nothing to do. They got lucky. So what I want to do as an analyst is take that number, be aware of it, but set it off to the side when I do my forecasting. I don't want that number to be a part of my future forecasting. So I would want to recast or restate the financials in the absence of foreign currency translation, adjustments, and losses so that I could purely identify those revenues that had come from the business. And once I had those purely identified, I'm gonna be able to forecast with greater confidence what's likely to happen in the future. And you'll see here in a minute that in 2019, they actually incurred a $900 million loss due to the same thing. Excuse me. Okay, covered all those. On the balance sheet side, it's important to know that if a US company borrows in foreign currency, and then the US dollar depreciates against that foreign currency, that liability just grew. Now it's going to take more dollars to pay back that loan in a foreign currency. Number three, a foreign subsidiary's cash is repatriated. So if the dollar weakens, that foreign currency that's repatriated into US dollars buys more dollars. Works the other way around if we're repatriating cash from a foreign subsidiary. And there it is. This is the disclosure that tells you that Pfizer booked a $900 million loss, or second line, 0.9 billion was the adjustment to revenues from translation adjustments in 2019. Okay, let's move on to accounts receivable. Same story as sales returns and allowances. When we made a sale and we knew at the same time a certain percentage of that sale was going to be returned, we had to book it. When we book sales on credit and debit and accounts receivable, we know immediately that there's going to be a certain proportion of those sales made on credit that will never materialize. We're going to have to write off some of those because people won't pay us. And we estimate that up front as soon as we make the sale on credit. Now, in the top table here, what's this telling us? In the top table, we can see how this is booked on the balance sheet, always net. So you see trade accounts receivable less allowance for doubtful accounts shows up as one line net of any allowance that we've booked for bad debt expense. On the bottom of the table, you can see how we typically calculate bad debt expense. There are several methodologies. This is probably the most common. This is an aging accounts receivable table. So you can see the current sales or current receivables balance is $50,000. We know that 2% of current receivables are going to go bad. In the past 60 days, we've booked $30,000 worth of receivables. So $30,000 are 1 to 60 days past due. We know that once they get to be 1 to 60, 3% of those go bad. 60 to 90 days, 4%, and over 90 days, 8% of those receivables will ultimately go bad. Do the math, and we have a total allowance for accounts receivable should be 2,900 out of total sales of 100,000. Here's the accounting entry for something like that. We just sold $100,000 worth of sales on credit. To establish the allowance account, which needs to be 2,900, we're going to make the following accounting entry. We're going to debit sales for 100,000. We're going to credit accounts receivable for 100,000. Then we're going to debit bad debt expense for 2,900 and credit the allowance for uncollectible accounts for the same 2,900. And now we have established our allowance account. The next entry can be a little tricky. I see this trip people up. fairly frequently. Assume a customer who owes 500 files for bankruptcy. If the company determines the receivable is now uncollectible, how do you write that off? Well, you would make the following entry. You would debit the allowance for uncollectible accounts, 500, and you would credit accounts receivable. Why don't we credit bad debt expense? Why don't we debit bad debt expense? This is where we're actually writing it off. And the answer is we already did that. We made the estimate. As soon as we made the estimate in the prior slide, you saw the entry for bad debt expense. It's already been expensed. We have the allowance account. Because we've already expensed it, anytime a debt goes bad in the future, we're just going to net that against what we've already allowed for. So when we write it off, it's booked against the allowance account. What happens? On the prior slide, we established an allowance account for $2,900. What happens in the quarter if we write off $3,000 worth of bad debts? We don't have enough bad debt expense, do we? We only have we've only booked $2,900 worth of bad debt expense. So in that circumstance, you would do exactly what I asked you. Why not? Why wouldn't you do it that way? You would add more bad debt expense. You'd have to go back, you'd have to add more bad debt expense, and then you could write off that debt. And that can be a tricky test question. It's not uncommon for authors to try to fool you by working a question in that manner so that you run out of bad debt expense and you're thinking to yourself, well, what do I do now? These are the ratios you want to monitor to make sure that you don't have any shenanigans going on with the estimates associated with allowance for bad debts. And this is exactly what I want you to look at in relation to your research project. Look at accounts receivable turnover, which is sales divided by average accounts receivable. Notice the average. It's very tempting just to take sales divided by accounts receivable. That's actually what I use in practice because I'm lazy. But the technically right way to do it is average. So you'll see that go back and forth. Days sales outstanding, 365 divided by average turnover. And you can see both of those numbers there for Pfizer. Once you have identified both of those numbers, go back and look at the prior 3 years, prior 5 years, prior 10 years, look for a trend line analysis, identify any fluctuations, and come to some determination about whether or not you might need to recast the financials. So once you have those numbers, you're going to be able to see whether or not credit quality is improving or deteriorating. In the case of Pfizer, we're going to see that it's actually improving. But when you look at let's just look at Pfizer's here. So Pfizer's accounts receivable turnover, top highlighted line, goes from 5.6 to 5.9 to 6.4, 6.4, and 6.5. What's that mean? Accounts receivable turnover, sales divided by average accounts receivable. So for every dollar's worth of sales, they are collecting more accounts receivable, 6.6 times worth. They're collecting faster. Their credit quality is improving in this case. If it were the other way around, it might be a little bit of a pink flag, maybe a red flag. You would want to ask yourself as the analyst what could be driving a deterioration in sales. That's a little bit, that can be a little bit alarming. Bottom highlighted, you look at average days sales outstanding, gone from 65 in 2014 to 55 in 2018. Those are generally pretty good numbers. So Pfizer's moving in the right direction. And let's see here. Slide 43 shows us what the 10K filing is going to have in the footnotes. When in doubt, always check the footnotes, and you can see the aging of the accounts receivable, or rather the reconciliation from that from year to year, and the additions charged versus the deductions shows up in the footnotes. So this is where we get all the data that we need to calculate those ratios. Okay, I'm going to move on to learning objective number 6. Analyze operating expenses and discontinued operations. I mentioned discontinuing operations just a moment ago, but we're also going to look at operations. So I started this class off looking at the balance sheet, looking at cost of sales, the deductions that came from revenues. Now we're going to look at cost of sales, SG&A expense, or selling, general and administrative expense, research and development. There's not a lot for us to talk about with most of those line items. If you get to really analyzing the fine print in the back of your 10K filings, you'll see a lot of ink spilled describing what goes into each of those categories. Make sure you spend the time and read the specifics as it relates to your individual companies, because you're going to learn a lot. You're going to learn about any accounting policies that might be germane to your business and how they might have interpreted FASB a little bit differently from maybe one of their competitors. But there's nothing globally in this section that we're going to take a deep dive into. Research and development expense. How do you account for research and development expense? If you're Pfizer, you may have R&D costs that are in the millions to tens of millions of dollars. So you spend, say you spend $100 million researching a new cancer drug, and then you finally get that through FDA stage 1, FDA stage 2, FDA stage 3. You got $100 million invested, and now you have this new asset, this intellectual property, this new drug that you're launching. How do you account for that $100 million that you spent to launch that drug?
As the costs are incurred.
As the costs are incurred. That's exactly right. It sounds like, the way I teed it up, it sounds like a trick question, and I do that on purpose because I failed that question when I was, I had just passed my CFA exam, so I shouldn't have failed the question, but I was interviewing for a job with Sanford Bernstein in New York to be a telecommunications analyst. And I was on my 3rd or 4th interview that day. And the lady I was interviewing with asked me, how do you account for research and development expense? And I had vaguely recalled something in my CFA studies that told me that you could capitalize that. So in the example I just gave, you could make an argument that those costs could be capitalized. You pour all those R&D costs into a drug like Pfizer has for cancer. Well, you could capitalize that just like you were building a new factory or a new machinery. And I think I was remembering some loophole for software development costs, and I said that you capitalize it. And it was, I think it was the only misstep that I had all day, because she reported back to the hiring manager that I didn't know what I was talking about. And I got negative feedback that that I had missed that one. Fortunately, I impressed everybody else that I had talked to, so I ended up getting the job. But I'll always remember that one. So research and development costs are expense as soon as they're incurred, and then you never see them again. But if you're a technology company, or if you're a software company, or if you're a drug manufacturing, they're extremely important. And what you want to do as an analyst is keep track of those costs as they vary from year to year, maybe relative to sales, maybe relative to assets, so that you can, well, what you want to know is that the management team is not skipping on their R&D. Because if you're a tech company, it's crucial that you load and reload that pipeline of new goods and services or new drugs or new software year after year after year. And just like sales returns and allowances, if you need to find the penny, if you need to boost earnings, say research and development costs are a very easy line item to dial back in any particular quarter or any particular year. Okay, there's slide 50, there's two on here. And one of them we talked about, discontinued operations. Those are the operations that management has decided to scuttle for one reason or another, and they're segregating them on the income statement. They are differentiating them from the ongoing operations of the business, and they show up separately. Same for restructuring charges. Management will oftentimes identify restructuring charges and highlight them as being not pertinent to the ongoing management of the business. And when they do that, again, I'm going to encourage you to think skeptically about that, because you see management teams very frequently employ both of those categories of accounts to, well, I'm going to say maybe hide stuff that they don't want you focusing on. Here is the analysis of R&D that I was hinting at a moment ago. You can see Pfizer's R&D here on exhibit 5.4 relative to the rest of the industry. Pfizer's at, let's look at the far right-hand column. Pfizer was 14.8% of revenues in 2018. On the lower end, maybe Bayer and Glaxo at 12, J&J at 13. Look at Merck, second from the bottom there, at 22% of revenues. Merck is very heavily investing in their future pipeline. And you're going to be able to draw a correlation between this R&D. Yeah, sorry about that. Come on in.
Let's grab in that,
Yeah.
I'm sorry to interrupt you.
Oh, no problem.
So sorry. I owe you one.
No, not at all.
Thanks so much. Appreciate that.
So Merck up here spending 22% of revenues with nothing else to go on. If you knew nothing else about any of those companies, which one would you bet on? Well, maybe Merck. They're investing heavily in their future. That's likely to pay off in future revenues in 2019, 2020, 2022. Oftentimes your R&D will spike as you move a drug through FDA approval. So Merck might have been onto something there. Whereas Pfizer, the 14% might indicate that they're letting their pipeline languish a little bit. That might be some cause for concern, and has been in the past with a company like Pfizer. Yes.
If you were an analyst and you saw like all the R&D decreasing for a company, but like, for example, they were increasing their mergers and acquisitions that they're doing with other drugs, would that kind of offset your forward-looking prediction of how the company is doing, even though they are decreasing R&D?
Yeah, that might be okay. Okay, so it's a great question, because with everything that we cover, there's always a contra case, and that contra case might actually sway your opinion more than anything else that the numbers would typically indicate. So for a company like this, Pfizer's not a great example. J&J is not a great example. Abbott Labs. Abbott Labs saw a huge spike in their R&D in 2016 when they sold their stent business to Guidant. Because their stent business was medical device. So they weren't actually spending any more money on R&D. They just took a big portion of their business and they sold that unit. So the ratios now all of a sudden were no longer apples to apples. But if you hadn't adjusted for something like that, then you might have only seen a big spike in R&D and misinterpreted. That's a little bit different than the scenario you described, but it might be the other way around. If they had bought a medical device company, so Guidant would have been on the other side of that transaction. Guidant bought Abbott Labs stent business, and you might have seen a reduction in their R&D. That's not a great example because they were already medical devices almost exclusively, but I think you get the point. There is almost always another side to the story because, well, that's why we start in Module 1, the first week of this class, are things like SWOT analysis and Porter's 5 forces. You have to know the competitive landscape. You have to know the business model of not just your company, but the business models of every other company in the industry so that you can understand who the players are and how they're strategically positioning their company to gain a competitive advantage into the future. And that competitive advantage may lead to things like R&D ratios sinking, or maybe to gain a competitive advantage, somebody like Levi is deciding they want to go overseas. And to go overseas, you have to be more lenient with your credit policies. So you'll see a sales return and allowances spike, and you'll think to yourself, well, that's perfectly normal given their competitive position. And as a matter of fact, I like management strategy here, so I would expect to see that, and it's more of a confirmation than it would be I guess a counter indicator. So really dig into the competitive strategy so that you can interpret these numbers. Without that strategy, you're just not going to have the right background to interpret the numbers. Okay. Don't need to talk about taxes. That's pretty straightforward. Already talked about discontinued operations. Okay, with our last 4 minutes, I'm going to move on to pro forma. Here's what you need to know about the words pro forma. Pro forma numbers are restated. And they can be issued by a management team anytime they want to give you an apples to apples comparison of anything we've been talking about tonight. So if you've had a major change in strategic positioning, if you've had discontinued operations, if you've had restructuring costs, management team can go back and restate their financials, and they'll give them to the Wall Street community and they'll call them pro forma. And that's basically a management team telling you as the analyst, look at these numbers. These are the numbers we want you to look at, and these are the numbers that we think are most indicative of our business. Then it's your job as the analyst to say, okay, well, I see what you've done here. These are non-GAAP numbers, so they're not regulated. Your job becomes some sanity check on whether or not you believe the management team. Oftentimes, pro forma numbers can be useful, but they come with a disclaimer by the SEC reminding everybody in this room and everybody on Wall Street that they're non-GAAP. And because they're non-GAAP, they should be taken with a grain of salt. But you see them all the time. And the example here is Pfizer issues a number called adjusted diluted EPS. And as you can imagine, all of the adjustments that they make are typically in their favor, designed to focus your attention on what they want you to focus. And they'll give you some breakdown of what they've included or not included in their adjusted earnings. And they usually publish those every quarter, and it usually takes the first 30 to 45 minutes of the call to go through those adjusted earnings, and you only ever get to diluted GAAP EPS if you actually read the SEC filings. Very rarely on a conference call does management team talk about diluted GAAP EPS. They talk about adjusted non-GAAP EPS and present it to you like it's the more important of the two numbers. And if you have a management team that is honest and has a lot of integrity and has a history of shareholder-friendly activity, then maybe those adjusted numbers have real value. But for other management teams, buyer beware. Okay. Slide number 63, star this, tear this page out of your PowerPoint and just stick it in your pocket. This would be a good one if you come away from this class with just a handful of slides that you keep for the future. This would be one of them. This is a really nice summary of what you want to be aware of as an analyst. First bullet, you want to make sure that you read the auditor's report, read the footnotes, examine accounting policies, compare key ratios over time. I mean, this is a cheat sheet for the steps that you need to go through to be a good analyst. When you're looking at analyzing any company, go through these steps. I think I mentioned to you in the first time we met that one of the best tips I ever got as an analyst was to take the 10K filing and instead of reading it front to back, flip it over and read it back to front, because all the good stuff's in the back. And that can feel a little bit painful because reading a 10K filing, it's not fun. You have to do some real digging to understand what you're reading. But that's where all the good stuff is in the fine print. So this is a good cheat sheet. That's all for tonight. We're at time. Thank you. Appreciate it. Reach out to me this week if you got questions on the homework or the exam. Otherwise, I will see you in 2 weeks right here. Thanks, Zoom crew. Have a great night.
Do you have anything more to do for our research project yet?
No, nothing. Somebody reached out to me, might have been you, was asking me about the milestone assignments on the syllabus.
It said something about that due today or.
Those
something.
are suggested
Uh-huh.
only. So if you're on pace, that's kind of where you'd be.
Okay, is that like outline or something on Canvas somewhere?
Just in the syllabus.
Oh,
Yeah.
okay, awesome.
Yeah.
Thank you so much.
Yep.
Hey, I just had a really quick question. I have an interview on Wednesday that I'm like kind of terrified for. Do you have any suggestions for like places to look up recent deals from that are free, not Bloomberg? That like a bank has done for like left lead drug running stuff. I can't find anything online about this bank and like what recent deals they've done.
What's the
since
name of the bank?
TD
Ameritrade?
Securities.
TD Securities.
Yeah, it would be the New York Levin Group.
I don't know of a data, like a deal database. Is that what
Yeah.
you're looking for?
Yeah, kind of. I was like browsing Fitch, couldn't find
Mhm.
anything on there.
I know those deal databases exist, but I can't think of one that UMKC has access
That's what I was
to,
thinking too.
rather than just, I mean, if you go into the ProQuest database, it's kind of just a hunt and peck methodology,
Yeah,
but you'll find it. It just won't be aggregated for you. Like,
Yeah.
You just go in there and search. It's like Google searches, but you'll get all the relevant articles that would have chronicled something like that in the last 6 to 12 months.
okay, perfect. I'll have to check that out. I also just might try to mooch Bloomberg off of one of my friends too, so.
Well, you have access to Bloomberg over here
Oh, we have one?
we have a bunch of them.
I did not realize that.
Yeah.
Huh. I'll try looking that up.
So the technology lab is straight across,
Yeah,
and I don't remember what the hours are, but it's probably posted on the door.
yeah,
And then on our Canvas site, under resources, there's the Bloomberg Access Guide.
Okay, cool.
Yeah.
I did not realize that. Well, thank you so much for letting me know that.
Yeah, so if you have time, go play around with one of the Bloombergs, and you can also find a bunch of, what company are you doing?
Global payments. I don't know why I couldn't do that.
Okay, so, look up a bunch of research on global payments.
Okay,
While
perfect.
you're
Will
there,
do.
yeah.
Thank you so much. I
Sure.
appreciate it.
Hey, I just want
Yes,
to say
sir.
hi. I'm gonna be helping out on the CFA Research Challenge team.
Oh,
so I just
awesome. What's your
wanted-
name?
Greg.
Greg,
Miller.
nice to meet you.
Yeah, you too,
Yeah,
you
this,
too.
we got Cerner.
Yeah, sir.
Okay,
Yeah.
so it's you and two other guys.
Me, and then Ryan, and then Chase Dalton. I haven't met him before.
Okay, Chase's name sounds familiar.
Okay.
I think I've met Chase. I
So
don't
I've
know
taken a
if I've
couple
met
classes with
Ryan.
We're a
Okay.
big fan, So.
Well, this will be a fun one.
Yeah, definitely.
Yeah,
So-
Doug Clark does a good job. He kind of roped me into that a few years back, and
Okay. Yeah.
we had a team go to nationals. It's probably been 4 or 5 years ago now, but
Yeah.
that was fun.
Yeah.
Well, let's do that again.
Yeah, I'm down.
All right.
Sounds good. All right.
Awesome.
You have a good night.
Yes, sir.
So, the My Business course.
Yeah.
I don't know if you can see whenever someone submits a tech support ticket, I doubt you can.
No.
I did, because I was having trouble getting into the homeworks and the video lectures and all of that on the My Business course, the YouTube, all that's fine.
Yeah.
Went through Canvas. And they walked me through and they had me go through on my phone, and it worked fine on my phone.
Huh.
And for whatever reason on my laptop, it wasn't working. We found out it was because of the firewall on my router. They had me
Okay.
plug through the ports to let the video lectures work through my router on my laptop. But I haven't had access to the homeworks this entire time, and
Okay, well, that's
but I've read
frustrating.
I've read through it all. I don't know if they're still open. Can I go in and, because I just resolved this morning with them, and they resolved my ticket.
Oh, yeah, no problem. You can go, they'll be open all semester.
Because I need to get this sorted before I get to do the exam on October 4th. I
Yeah,
have to get this all done before then.
you'll have no problem.
Okay.
It'll be open.
All
Yeah.
right, I just want to make sure.
Yes, sir.
Thank you.
Hey,
How you doing?
good. How are you?
Good. I have this for you.
Thank you.
I couldn't really get my picture to print
Uh,
properly, so.
looks great.
I had to
Oh,
put it
you're
on-
Chase.
I am Chase.
Yeah, okay, great. So,
I'm on the
you're
CFA
on the
team.
team. Okay, did you know Greg?
I have not met him yet,
Oh,
actually.
okay.
I know nobody here. Since I went to Pitt State for my undergrad, I just came, this is
Okay.
my first semester.
Well, your
here.
name sounds familiar. Have we met before? Maybe we met.
Yes.
Maybe it was that first class we met.
Yes, first class, but that was like a month ago.
Yeah, okay, yeah,
Already,
yeah, yeah.
you
Okay,
know.
well, I wasn't going crazy, man. I thought. And that name
We've
sounded
only been
familiar
in
for a
class,
reason.
I think one time, because
Yeah.
of the holiday and then.
Yeah, and then we had to
travel.
go Zoom. But yes, well, great. That'll be nice to have you on the team.
Yeah, I'm really excited about it. My professor down at Pitt State, he was do you know the name Kevin Bracker? He, I know Dr. Clark knows him. He liked fielding teams down there. He retired, I believe this May. But he always loved the research challenge. He was a CFA as well, and he always thought it's a great time, great experience.
It is. It's they always make a good show up. Trying to figure out how to log out of my little account here.
Which I'm a little interested to do does Cerner technically, do they technically fall under the healthcare sector?
Yeah,
Okay, because I know they do a lot of technology-based stuff, so I didn't know if they fell under that realm either. In my personal portfolio, I don't really use any of those companies. So it'll be kind of interesting to dig through.
yeah, it'll be a good project.
Do you think Cerner's a good company to do for the challenge?
Cerner's a great company. It's just a question of whether or not we can get them at a good price. They always pick a Kansas City company. I understand why they do. Just feel sometimes that it kind of handicaps the research project because, when you go to national,